Thank you, Amy. Much appreciated. Welcome everybody to the 2022 state and local tax update. So we do this presentation once a year, roughly around the same time, and it's a good year to do it because this tends to be when the states are just wrapping up their legislative session. So where there are tax changes across the states, we're kind of picking them up at the right time. So this year, it's because it's an election year, and I think too because just the states are doing so well from a fiscal perspective, and I'll talk about that in a second here. There hasn't been as much activity as we typically see, but that's a relative observation because there's always a ton going on at the state level. So that is not to say that there's not a lot to talk about here. In fact, between 50 jurisdictions and all the localities out there, we can't possibly hit on everything that's going on. So for the most part, we're going to be focusing on, kind of bigger themes that are going on across the states, and hopefully hitting on the big developments that you all need to know. So quick introduction of myself and my fellow presenters. So I am John Gupta. I am the principal in charge of our state and local tax practice, which is part of our national tax office at Eide Bailly. I am speaking to you from Boulder, Colorado today. With me today are two of our fantastic senior managers. We have Iris Chung, who is in Washington, D.C. Iris, longtime member of our group. She focuses on income tax matters, state income tax matters. Also with us is David Casper, who is at our firm's home base in Fargo, North Dakota. David, also a longtime member of our group. He focuses in sales and use. So you will be hearing from all three of us today. So quick view of our agenda today. So I'm going to kick us off just kind of talking about a little bit about the state of the states, which I will give you a little context on what I'm trying to accomplish there in a minute. We have a full carve out on probably what is the most significant development or hot topic in state and local tax, and that is the state pass-through entity taxes that have been adopted essentially as workarounds to the federal SALT cap. So we'll spend some time on that, and then Iris is going to take us through kind of all the rest of the state income tax developments that we wanted to address today, and then David is going to wrap it up by kind of talking about some practical matters around sales tax nexus. Couple of years following, well, 3 or 4 years following the WAYFAIR decision, and I think his presentation is going to be kind of focused on sort of what we've been seeing there and some of the practical realities post WAYFAIR about sales tax nexus. So, so let me start with state of the states, and I do this with most of my state kind of annual presentations because I do think it's important for everyone to understand kind of what the state fiscal picture is, what the political situation across the states is. It just helps to kind of put everything into context and understand kind of what's animating the different decisions and political things that are happening out there. So I always like to kind of touch base on that before we get into the developments themselves. So always kind of start out by saying that unlike the federal government, the states have to annually balance their budget, so they don't get to print money like the feds do, which kind of creates a totally different circumstance in terms of how the states approach their budgets. Kind of an interesting, as we're a couple of years past the pandemic now, there was, when the pandemic started, there was all kinds of dire predictions about the states having to default on bonds and declare bankruptcies and all of that. So that just didn't materialize, all of those dire predictions about state revenues. In fact, during the pandemic, state revenues increased 12%. And basically the bottom line is none of those predictions materialized. And we as a society just figured out very quickly how to adapt and kind of move business online. So the two kind of biggest revenue sources for the states, personal income tax and sales taxes. While there was some weakness in the personal income tax in certain segments, for the most part, the higher paying jobs were all stayed. And in fact, due to labor shortages, we saw higher wages. Of course, inflation on accompanying that. So basically personal income taxes and sales taxes really went up. And from a sales tax perspective, the WAYFAIR decision kind of came right in time, where most of the states had already adopted those principles and were collecting sales tax on online sales, which with all of the close downs and lockdowns, really business didn't decrease that much. It just all went online, and the states were in position where they were able to tax that. So in addition to that kind of situation where the states really, for the most part, were looking at surpluses when they were anticipating doom and gloom, then along comes the America Rescue Plan Act, otherwise known as ARPA, which was signed by President Biden in March of 2021. And that earmarked another $350 billion to the states. And when you're looking at the slide there, that actually is not correct, that every state got $350 billion. It was a total of $350 billion allocated across the states based on population, essentially. So, but that's still a lot of money. And just to kind of take it home to a particular state, California, who was, predicting terrible things coming right at the outset of the pandemic, and they usually are in a very difficult situation from a budget perspective anyway. They ended up with a $15.5 billion surplus for the FY 2021 year. And then on top of that, got $43 billion in ARPA funds. So, so basically the states are swimming in cash right now. And that, coupled with the fact that we have an election year coming up where politicians don't want to be branded as increasing taxes or doing anything really that's that they can get blamed for at the ballot box. Basically, the states are sitting on these tremendous surpluses. They're building rainy day funds, which is a great thing. And they're really looking during this legislative session to return surpluses to taxpayers. So this year, we didn't see a lot of tax increases. We saw very few across the states from a legislative standpoint. Much more focus was on personal income tax rate reductions, as well as gas tax suspensions and kind of payouts to citizens that, were either branded as meant to help with inflation or meant to help with increased gas prices. So really, it's been a situation where very few tax increases, more politicians kind of looking to reduce taxes, and that's what we sort of saw in this legislative session. So now, long-term picture is a little less certain. Recessions, and I know there's a lot of conversation going on right now as to whether we're in a recession or if one is coming up. A lot of disagreement there, but when a recession occurs, that tends to be pretty devastating to the states because their revenue sources are so recession sensitive. With the ARPA funds also being kind of a one-timer, even though a lot of them are sitting there unused at this point because the states have so much money they don't know what to do with it. That's not likely to happen again. So with tax cuts, the politicians really have to be a little sensitive about impacts future-wise, not to get themselves into a difficult situation going forward. But again, kind of the basic theme that we're seeing here is very much focus on tax cuts and going to flat taxes as opposed to tax increases. Quick note on the political situation, because we hear a lot about the federal elections, but the upcoming elections on the state side are extremely significant, starting with the fact that we've got 36 governor elections, which that may seem crazy, but that's kind of how it all plays out from a timing perspective. They all kind of happen at once. And so we have 36 gubernatorial elections. And I think there's a combination of some governors who are term limited and others who are defending their seats, but there'll be a lot of potential for change there. And then we have trifectas and vulnerable trifectas, which are always interesting to watch from a state policy perspective. What is a trifecta? A trifecta is when a particular state, there's one party that controls all three branches of government. That's the governor's office, the House, and the Senate. Not technically branches, but basically the legislative branch and the executive branch are all controlled by one party. And as you can see there, 37 of our states have trifectas. There's a couple that are noted to be vulnerable. Arizona is a highly vulnerable one from a Republican standpoint. Delaware from the Democrat. The others that are listed there are deemed to be moderately vulnerable, but certainly something to watch in the upcoming elections. Another phenomenon that's always really important to kind of watch from a state tax perspective is the ballot measures. And so this is technically not a political phenomenon. It's these are all citizen initiative petitions that get measures on the ballot. And what we've kind of seen is that while the politicians have been pretty quiet in terms of tax increases, there is still that kind of theory out there of wealth or income inequality and taxing the rich to fund social programs and that sort of thing. We saw a lot of that in the legislatures last year. This year, it's more manifested at the ballot box. So as you can see here, there's a number of significant measures that are coming up. California, if that one should pass, they're getting close to a 15% top marginal rate. Go down to Idaho. This one was kind of interesting to me that they're proposing a very high rate for what is a decidedly red state of almost 11%. So that one will surprise me if it goes through because they, I think, inadvertently reverse some of the legislative tax cuts that Idaho just passed in this legislative session. I don't think they meant to do it, but this actually will increase taxes for everyone, not just the wealthy, when it goes on to the ballot box. So these things are always, there's always a potential for tax increases to come through this way as well. So just quick, I think overall summary of what we're seeing from an overall perspective is near term, the states are doing great. They've got more cash than they know what to do with, a little bit more risk on the horizon. So with the elections coming up and the states being awash with cash, again, very much focus on, rate reductions and not so much in terms of increasing taxes. It's more likely that the citizen initiated ballot measures are going to result in tax increases rather than the politicians at this point. The other thing that's a really kind of significant macro issue from a state tax perspective or state policy perspective is that it is just a lot easier now for individuals to relocate. And we see it all the time here, people coming to us from high tax states who are saying, hey, I'm cashing out a business or I've got an income event coming up. Can you help me change residence? So we are seeing a pretty significant flight of high income people from the higher tax states to either the no tax states or the low tax states. And that coupled with the SALT cap and the limitation on the federal subsidization of state income tax rates, that's a real issue where wealthier folks are seriously looking at moving around. So, and then on the administrative side, I think interesting phenomena from the standpoint of the revenue departments. During COVID, there was a huge group of revenue officials and auditors who were a little bit on the more experienced side who went into retirement. And so we're seeing a lot less experienced auditors, which you would think that'd be a good thing, but in most cases, that's not necessarily a good thing to deal with the less experienced auditors. And they're too having, just like private businesses are having a lot of difficulty in terms of hiring and retaining people. A lot of the younger folks are looking at other options in private, and you also are seeing a lot of different government agencies kind of picking folks out of other government agencies. So they're really struggling there. But I think we can expect to see audit focus continue. We're expecting to see a lot of activity around WAYFAIR. David's going to talk about that a little bit more, as well as audit activity around residency issues. As I mentioned, people are kind of moving around, and the states certainly know that, and they're not going to let you break residency all that easily. And so that's something, definitely have to dot all your I's and cross all your T's on those residency changes before they're made. So, okay, so let me talk quickly about an update on the state pass-through entity taxes, because as I mentioned, this is probably the most significant development over the last couple of years in SALT. And so we've got a couple of years behind us now of dealing with these, as we now have 29 states that have adopted these things at this point. And so this is a major part of what I deal with and IRIS deals with day to day, as well as most of the SALT professionals out there. So a lot going on here. For those who aren't familiar with what this is, just a real quick refresher. This deals with, one ahead there. This deals with the federal SALT cap that was passed as part of the TCJA. So I think many of you are aware that in the TCJA, there was a $10,000 cap on individual SALT itemized deduction that took effect in 2018 and is scheduled to sunset after 2025. So basically, since the beginning of the modern income tax, the federal government has always subsidized state income taxes, and they stopped doing that with the TCJA. And so there's a lot of political conversation going on around that in Washington. I think all the conversation that's out there right now, basically it's gridlock. I don't see anything changing up until that 2025 sunset. And even then, there's probably a pretty high likelihood that regardless of who's controlling things at that point, that could get extended. So, and in the recent budget reconciliation that the Senate sort of agreed to in principle last week, there was no mention of the SALT cap at all in there. There is a coalition in the House that is basically said that if there's no change or easing of the SALT cap, we're not going to vote for anything, but not sure how they're going to react when that reconciliation bill comes before that. But my guess is they probably aren't going to want to stymie the success that the Democrats are having with that bill. So what did the states do to react to that? They developed these pass-through entity taxes. So the basics there is, and the kind of the starting point to understand is that the cap only applies at the individual level. It does not apply to businesses. Businesses are still allowed to deduct their state taxes in full. So what we're talking about here are taxes as a state devised structure. And politically, by the way, this is sort of a non-partisan issue at the state level. Both Republicans and Democrats see this as an intrusion on state sovereignty. And so there's been basic support across the different political spectrums at the state level to get these started, as evidenced by the fact that in a 3-year period, we now have 21 states that have these. So again, basically what happens is the state creates a tax at the entity level, and most of these are optional or elections where state individual entities can make the election to do this or not do it. And it basically shifts the tax to the pass-through entity level. That pass-through entity gets the full deduction, and that reduces the K1 income that flows through to the partners or to the shareholders. So it effectively allows an unlimited SALT deduction on K1 income from pass-through entities, and is theoretically neutral at the state level itself because the owners of the pass-through entity typically will get a credit or a subtraction modification to reverse out the tax that was paid at the end. So that is this whole structure. There was some question about whether or not the IRS was going to bless this, and they did in November 2020. And then at the time that they blessed it, there was about 7 states that had these. And after they blessed it in 2020, there was sort of a waterfall or the floodgates open where a whole bunch of additional states brought these on. So this is kind of where we are currently. The 3 columns to the left are the states that have adopted these. Missouri just adopted theirs. They were the last one just 2 weeks ago. In Ohio, a couple weeks before that. So things are still moving pretty quick. Iowa, Pennsylvania, and Vermont also have bills to adopt these, and wouldn't surprise me if in the next legislation we saw, or next legislative session, we saw more. So here's a map kind of reflective of the prior slide. The states in blue are those that have pass-through entity taxes. Those in yellow are ones that have serious bills that could still be enacted this year. So just a couple of observations. Now that we've been working on so many of these, I want to throw out a couple of messages or observations for folks. So one thing that I think is critically important is that no one should just go headlong into making these elections just thinking about that federal tax benefit. That federal tax benefit is great, but there's a lot of hair on these from both the federal and state level that really I think people need to kind of peel that onion back and make sure they understand all of those issues before making an election. Couple of kind of key issues to think about. You may need to restructure your entity to take advantage of the benefit or make the election. Disregarded entities generally don't qualify. So in those cases, you might need to find or create another partner to create a 1065 entity. Some states don't allow entities owned by other pass-throughs or corporations to qualify. So in some cases, you'll need to restructure the ownership to move it into eligible owners before making the election. And it may be one of the bigger issues that we've seen is the discord that can come from partners, different partners being sort of getting different levels of benefits or detriments. There are a couple of states, California is the most notable one, that allow individual owners to opt in or opt out, but most of these, it's an all or nothing thing where the entity itself will make the election and everybody is stuck with it, whether it's good or bad. And so you can have differences between minority partners and majority partners. You can have difference between residents and non-residents. So really need to think through those things to make sure that everybody is on board and it makes sense for everybody. And federal benefit, is it worth it? You know, in some of the lower tax states, like my home state of Colorado, where we only have a 4.5% rate, you know, it takes a lot of income for this to make sense or to go forward with this, where the benefit is worth, you know, the cost of putting it together and going forward with it. So, and then two final issues where I think really these are kind of the biggest ones that people have sort of stumbled on a little bit. One is the timing of the federal deduction, where it's interesting that most states require that the election be made on the tax return. And so usually, as you all know, you're filing that tax return in the year after the year to which it relates. So the election itself is made in the year before the federal benefit that you're seeking is actually applied. So for cash basis taxpayers, you will want to make your payments in the year of the election, even though you're not making the election to the next year. And some people who decide, oh, I'm going to make an election when they're filing a return, find that it's too late to have that benefit for the prior year. Now, most of the states have estimated payment provisions. So if you're following those, usually you're getting your payments in correctly and getting setting up to take that benefit in the election year. But some just aren't contemplating the election until they get around to filing the return, in which case you're not getting that benefit. And then accrual basis taxpayers, there's a whole other issue where there's some risk at the federal level. Even if you're making those payments before making the election, can it be said that that tax liability for the entity is fixed and determinable when the election has not been made yet? So we feel there's some risk out there that in theory, the IRS could deny those deductions for an accrual basis taxpayer. So we're hoping that the IRS issues guidance on that. It hasn't happened yet, but just something to think through. And if you have an issue with that, we like to get our methods folks involved over here to help us get through that. So, and I'm probably, and this is my final point on this, this is probably the biggest thing that I caution everybody to make sure that they get their arms around this before making an election, and that's the resident credit for taxes paid to other states. So if you are a resident of state X and you are making an election in state Y, and you are no longer paying your tax in state Y, an entity is paying your tax in state Y, the question out there is, do you get to still claim that credit as a resident of your home state? Because you're not paying the tax anymore, an entity is. So there are a few states that have come right out and said, no, you don't get that credit when you make the election in another state. There's a large group of states that just don't say anything. So there's just uncertainty out there, but it's pretty critical to get your arms around that before making the election and make sure you're feeling comfortable with that, because if you don't get that credit, then you're getting double taxed in two states on the same income, which in almost every case is going to supersede the amount of the federal benefit. So very important to get that one figured out. Okay, so that is all I have on pass-through entity tax. There's obviously a lot more to be talked about there, but we only have an hour to get through all of the fun stuff going on in the state world. So if anybody has questions on that topic, feel free to use the Q&A and our contact information, mine and the rest of our presenters are also within the presentation, I think, right at the end, and feel free to reach out to us with any questions there. But I will turn it over. I think I went over a little bit. Sorry, Iris, but I'm going to turn it over to Iris to kind of walk us through some other state income tax developments that are going on right now.
No worries, John. Thank you. Happy Monday, everyone. Yes, I have control. So John had talked a lot about the pass-through entity taxes, and I'm going to cover just some highlights in a couple of states. And the two cases I'm going to cover that came down recently this year address allocation and apportionment to the extent that gain is recognized either from the sale of a partnership interest or an S Corp, and it might be recognized by an upper tier owner flow through or by an individual. In this case, can be some misunderstanding of what the individual sourcing rules and the corporate entity apportionment rules are, because in some states, the flow-through entities are subject to the individual sourcing rules. In some cases, you have individuals that directly recognize the gain on the sale of a partnership or S Corp, or it's a flow-through entity that the individual receives a K1. So in those different instances, the individual may be subject to the individual sourcing rules or the corporate apportionment rules. And there's differences between the two. The Multi-State Tax Commission is an organization that tries to create uniformity among the rules and among the states. And they are trying to come down with a rule on some uniformity around the sourcing of gain, and in particular, they're focusing on investment partnerships, which is different from, in many cases, we address clients who are selling an interest in an entity that they had been actively involved in operating. So one of the cases that came down this year is in Massachusetts, and the decision was from an S corporation as to whether the S corporation, which was domiciled in Florida, was required to apportion to Massachusetts gain from its sale of an interest in a partnership that was headquartered in Massachusetts. The S corporation came about its interest in the Massachusetts partnership through acquisition. It was a passive S corporation. The partnership was actually a member-managed partnership. There was the two board members from the S corporation that were also board members on the partnership. However, it wasn't an active board. They met maybe twice during the existence of the partnership. So it was deemed by all the parties involved, that it wasn't a unitary relationship between the S corporation and the partnership. And that's significant because in Massachusetts, whether or not an owner can recognize the portion and consider it to be business income, the gain from the sale of a partnership interest, is determined on whether there's a unitary relationship between the corporation and the partnership. In this case, it was determined that they were not. So the court ruled that because you were precluded, since the Massachusetts law specifically said that there had to be unity, and unity was not determined in this case, that the gain could not be apportioned to Massachusetts. And this also applied to the actual resident, the actual corporate, composite tax as well. So, however, what's significant in this case, yes, the taxpayer won, but the court also, in what is addressed as dicta, which is unrelated to the case, unrelated to the decision, the court actually said that a state could look to the entity being sold as the basis for apportioning the gain that a non-resident recognizes on the sale of the lower tier partnership. So this could create double taxation issues. And in fact, there are other states that treat the apportionment of gain for the sale of a partnership, regardless of whether there's a unitary relationship. So this is another case to keep in mind that there are different states that have different ways, different theories of how they can tax a non-resident on recognizing gain from the sale of a partnership or an S corp interest. Another apportionment issue that came up through a case that was decided earlier this year is the Series XM case in Texas. So Texas applies a margin tax, which is based on gross receipts, apportioned gross receipts, otherwise known as the franchise tax. It is a gross receipts-based tax, less cost of goods sold. There's 3 different ways to calculate this tax. So Texas, in apportioning and determining what is sales revenue, that's Texas sales revenue versus outside of Texas revenue for services, has traditionally followed a cost of performance approach, where if the services are performed in the state, then they're apportioned to Texas. If there's no performance of services, then they're not apportioned. Under the Series XM case, all of the work related to, there were 150 satellite stations. Sirius XM was not based in Texas. None of the satellites were launched from Texas, operated from Texas. 70% of their shows were produced original content, and that occurred mainly in New York City and Washington, D.C., outside of Texas, although there was one show performed in Texas, and there's some activity that occurred in Texas, but it was a very minimal amount. So Texas determined, the lower court of appeals case decision that came out back in 2020 determined that the sales should be sourced based on the end product receipts producing act. So they turned their cost of performance sales sourcing to a customer-based sales sourcing and determined that Sirius XM needed to source based on the subscriber revenue that they earned in Texas from their Texas consumers. So Sirius XM's predominant amount revenue was generated from subscription services for the customers in Texas. That was the location. Primarily, that activity was what was occurring in Texas. So the Supreme Court in Texas overruled that decision and determined that that was going beyond the basic law of Texas of cost of performance and throughout the Receipts Producing End Product Act. But what further complicates things is that Texas decided at the beginning of last year to change its regulations to actually take into account the Receipts Producing End Product Act of the appeals decision. So they actually amended their regulation without legislatively changing their law and insert this language. So we may have a lot of taxpayers that have followed the changes in the regulation, and based on this decision, there is a possibility of an opportunity for refund to the extent that the fact pattern for the clients might be very similar to the Sirius XM case. So just another note that Texas, in its cost of performance rules, does have separate rules for sales related to intangibles, which can be sourced to the customer location, which is separated from services, which is based on cost of performance. So this comes into play when we see software as a service sourcing. Texas has particular internet hosting rules, which also source based on payor. So that's another thing to keep in mind. Please consult your tax advisor to the extent that you might think there might be a refund opportunity for prior years. The regulation that came down in 2021 was actually supposed to be effective retroactively to 2008. So they changed their regulation back in time, and now this decision raises the potential for a refund claim. So moving on. Another piece of guidance that came down in 2021 was the Public Law 86-272 guidance for internet retailers. The MTC adopted this guidance in providing additional lists of unprotected activities for internet retailers that would not receive 86-272 protection. So for net income taxes, 86-272 came into effect in the late 70s, early 80s, as protection for companies that specifically sell only tangible personal property and only perform sales solicitation activities in the state. So this guidance adds that now that we have internet resellers, we have to look at their websites to determine whether or not they might have unprotected activities. And basically any type of active website that even collects cookies information to gather customer research, alternates the inventory that a business might hold based on customers' responses and what they choose to put into their shopping carts, that would be considered to be an active activity on the internet that breaks 86-272. Any type of streaming of videos, if you have a site that accepts resumes for potential employees, if you have a chat box on your internet site, those break 86-272 protection. So there are two states that have already adopted this guidance. It's California and New York State. New York City intends to also issue a similar draft, and we also anticipate other states to follow. And just following with a couple of other, John mentioned legislation that's in the queue. Here's a couple things that have passed in several states recently within the past 2 quarters of this year of 2022. Arkansas is typically a cost of performance state, but there was an administrative decision that actually upheld sales sourcing based on customer location, where the department exercises authority to prescribe an alternative apportionment method that they felt was to fairly capture the amount of activity that the taxpayer was occurring in the state. And it was related to the selling of digital products. So that's something to be aware of, as we have a lot of clients who are in that realm of selling digital products. Idaho has traditionally been a cost of performance state, and they're implementing market-based sourcing rules for taxpayers beginning this year and in the future. Kentucky has enacted a 60-day tax amnesty program that has yet to be announced when the dates will be. It'll be either this year or next year. Missouri has enacted a research and development credit starting in 2023. It's been a while, long hiatus since they've offered one. So this will be tied to the definition of what is qualified, will tie to the IRC. And lastly, Nebraska is reducing its current corporate income tax rate from 7.5 to 5.85, along with an income tax rate reduction. As John has mentioned, many states are flush with revenues and trying to give back to the taxpayer. Pennsylvania, similarly, is reducing its corporate tax rate, which has long been 9.99%. To 4.99 over 9 years. Pennsylvania has also taken a market-based sourcing approach for intangibles, which will be effective for tax years beginning in 2023. Pennsylvania has traditionally been a physical presence state, and they enacted economic nexus rules, which they codified, and those rules are effective from the 2022 tax year and forward. Vermont is shifting from a 3-factor to a single sales factor apportionment formula for tax years beginning on after next year. And those are a few of the updates. This definitely doesn't cover all of the states, but if you have any questions, please feel free to reach out to us. I will hand this presentation over to David.
Good afternoon, everyone. The last portion of this will be on sales tax. So Nexus for sales tax and income tax are a little different. Just want to quick touch on those before we get too far along. The term nexus means the state says you have enough connection to their state, they can require you to collect their sales tax. Okay, so how do I get nexus? The old version that is still in effect was physical presence in a state that was more than de minimis, like having an office, employees or employees working from home in the state, sales rep in the state, knocking on doors, storing your inventory, whether it be raw materials or finished goods in a state. And this includes if you're using fulfillment by Amazon and they moved your product all over the country. You now have physical presence by virtue of your goods in an Amazon warehouse. Or sometimes, depending upon the state, they'll get into affiliated companies, creating nexus for you. So we can have the physical, or the next section is economic nexus. That's all a result of the WAYFAIR case. Typically, the states are saying more than 100,000 in sales. Some say 200 transactions. There's, I believe, 3 states out there with higher thresholds. California, Texas, New York are at 500,000. I believe Alabama is at 250. But for now, just think of it as having inventory or boots on the ground in a state creates nexus, or enough sales into a state. Once you have this nexus, it's almost impossible to get rid of. It doesn't reset every year. Once you have it, you have it. And it doesn't matter which one you trip first, physical or economic, you have nexus. Now, what gets to be our next bit here is this was the WAYFAIR case, came in 2018. And this is where that $100,000 line comes from. It's now been about 4 years. And this is where the states are now becoming active in targeting remote sellers. This economic nexus, as of June of 21, all the states that had a sales tax passed their economic nexus laws. I believe the last one to go on was Missouri. Theirs takes effect sometime next year. The first enforcement dates that came out were mid 2018 when WAYFAIR went through. And then we had our later ones coming in. So not all the states have a full 3-4 year look back yet, but they're getting close. And what I found really interesting was we'd always been discussing when are the states going to be actively targeting remote sellers. Well, I had an email come through my box the other day. Idaho Department of Revenue is actively pursuing an audit on a remote seller from Florida who has never been there. I think that's going to be an interesting call, but this is definitely a sign of things to come. So if you are remote seller, and you don't have to be like an Amazon or an Etsy, you can be a company that just happens to sell a lot of parts or items or cars, whatever it may be, over the phone. Just no presence in the state, but you are shipping something there, whether it be UPS or on a semi-truck. Heavy equipment dealers are really easy targets for this, as one of their items exceeds nexus in every state. So if you think you may have some nexus, economic or physical, across the country, please give us a call. Let's see where you might have nexus and where you're collecting. We can fix these things, and it is much easier to do before somebody contacts you. And also on the idea of before somebody contacts you comes to the point in your company where you're like, I would like to sell. I'm thinking it's time to retire and move on. I've been doing a fair amount of that lately, and we've found that sales tax is, well, not always a deal killer. It is very much a lot of discussion and stress, and what can we do to get through this? Typically, when a business goes to market, either this is how I'm going to present myself to the market, or how the market perceives the company that's for sale. This is how they show up at first glance, waxed, shiny, ready to go. You'd think, oh, this thing is perfect. I'm gonna just buy it and walk away. But given the size of the dollars involved, there's usually some questions that come. Most commonly, the buyers will engage the services of specialized due diligence teams who go through cost of earnings, and all these different topics. And they ask lots and lots of questions. The process can take months. I strongly encourage, if you're on the sell side, bring your own representatives. So we need to remember that the folks working for the buyers work for the buyers. And if you have someone on your side who understands what the buyers are looking for and can translate that accountant speak into plain English, it reduces stress. Also, highly recommended, if you're thinking 3 to 5 years down the road, I would like to do something different, have someone on your team, whether it's your accounting team, someone you trust, do an inspection before you put yourself out for sale, so that you can either repair things or control the narrative as the process begins and you are not caught off guard. So sales tax, I will tell you, is almost always an issue. And these buy-side teams, they never really find a rusted out frame to point at, but they always find sales tax issues. And when they find them, remember, they're on the buy side. They're not splitting hairs. They're not getting it down to the minimum dollar. Everybody's in a hurry, and they are supposed to come up with a reasonable number and put it out there. This is what we think the error is. This is used to reduce the selling price, and it is just a flying as fast as they can estimate without good data or getting all the way to the root of the issue. What we have happening then is we'll just do some true stories here. And the next definition that's going to come up in a true story is, you will hear us say voluntary disclosure agreement, or VDA. That is where a tax professional approaches the state on your behalf, says, hey, what can we do to get right? Can we control the look back? Can we get out of some penalties or interest here if we pay up the bill for the last 3 years? That is a voluntary disclosure agreement. These will either need to happen before a transaction, or most commonly they happen after. But let's just say the buy side is throwing out a really big number. Then they'll throw out the word escrow. They are going to hold back a number for what they think the sales tax amounts are, at which point they will hire a third party to come in and clean all this up, file the things with the state. What's to be really be aware of is when the buyer is saying, yeah, we'll just put it in escrow, and if nothing happens in 3 years, well, the money is yours. What they don't say is that they will hire someone like myself or another accounting firm to go through, scrub the numbers, and start remitting that money to the states, because now they need to be cleaned up. They're using your money as the seller to clean this up and get the business right with the state. Unfortunately, it's maybe not presented that way to the seller. And in one instance, I'm fairly certain that the new boat that the seller was expecting to have in another 60 days was no longer, because the voluntary disclosure process was started by the buyer. We'll do first the dark side. This is the most extreme. This was an online project. I worked for an online retailer of baby accessories. So we were working for the buy side. They came in and said, hey, can you do a high level on this? It looks really shiny. I asked 3 questions. Can I see your sales by ship to state for the last 3 years? I was over threshold in 30 some states. Tell me where you have employees. That's our physical nexus. Well, 3 states. How many sales tax permits do you have? 0 permits, none anywhere. I threw back, best guess, $1 million in sales tax was owed. That with some other smaller issues killed the deal. So that is an extreme. Now let's go a little more common, something that's still kind of fleshing out in my world. Clients on sell side, they're in the negotiations, they realize they have issues in 25 states. Seller knows that they're only collecting tax in 9. They've just got some bookkeeping issues, can't be helped. The buyer proposes to do a holdback from the selling price of the company of approximately $3 million. Well, when I started looking at that for the sell side, $200,000 was to update software, pushing 200 grand in accounting fees, 5,000 for penalties, which if we go back to that VDA definition, I can usually get those waived if we're doing the voluntary disclosure. And then the rest of this 3 million was just taxes and interest. So the buy side was there to be conservative and protect their client, which is what they were doing with the $3 million number. But the buyer is also asking for a whole lot more than maybe they should be getting. And this is why if you are selling, have somebody in your corner. That's super important. I think they settled out around 2 million. And that is a project that we will start fixing up as time goes on here. But had we not looked deeper, we would have left $1 million on the table. Now for the success story, I had a partner down the office here, row from me, said, hey, can you take a look at this company? Sure, we'll do that. And after a quick review, we had some income tax VDAs to do. I had some sales tax VDAs to do in 4 or 5 states. The numbers were large, but not huge. And your brain right now is saying, how is this the bright side? This Dave guy, he's out spending money everywhere, filing back returns and paying money to the states. But what happened was, and we didn't know this at the time, but after we'd started the project, they were approached with an offer to sell. The negotiations got to about the sales tax point of just magically about the time we had finished up our projects. Buy side was, tell me about sales tax. Client emailed me, I sent them all the paperwork for the voluntary disclosures we did, how we figured it out. Sales tax topic was dead right there. That what could have turned into weeks or months of stress trying to figure it out, done, and the deal closed shortly thereafter with no holdback. It was the bright side of how these could go. So in summary, whether you're buying or selling, please have someone in your corner. If you're thinking about selling, it would be wonderful if you started a couple, 3 years early just to get it all cleaned up to reduce the issues and stress later. And if you're buying, please always ask about sales tax, even if you think it's a small transaction. There are 44 states out there that say, regardless of how you buy the company or its assets, you are inheriting the seller's tax issues. And that gets us to the end and right about on time, Amy.
Well, I don't see any questions, so please feel free to reach out to our team if you have any questions. Thank you so much for attending.